Welcome back, guys. So in this particular video, we are going to talk about two types of return. First one is your pre-tax nominal return, and second one is your post-tax nominal return, or you can say after-tax nominal return. For the time being, you can ignore the word nominal. I'm going to definitely explain it to you later. And this particular video is important from the point of view that tax matters, because what you actually keep at the end of your investment depends on how much tax you have to pay. All right. So we are going to see how tax is applied on your different types of earnings in this particular video. So this video, I'll keep it short, very short, because not much is explained in your CFA book. So I'll stick to it. So let's begin. So till this point, all the returns that we have talked about are basically your pre-tax return, or you can say those returns are before tax nominal return. So for example, your pre-tax return is say $10 million, for example, and here you apply tax. So if supposing the government takes tax of, say, hypothetical example, 30%. So the 30% of this 10 million, 30% of this 10 million will be how much? It's going to be $3 million. So at the end, after you pay the tax to the government, you are left with 10 minus 3, that is $7 million. So basically, this $7 million is your after tax, say, nominal return. Okay. Hope you have understood till this point. So basically, it's nothing. Pre-tax is that return which you get after your investment, after deducting all the necessary things. But then government comes into picture, and they, on the profit that you earn, they take tax from you. And this percentage of tax could vary. Okay, I'm going to tell you how it's going to vary based on your earning as well. And it varies from country to country as well. So after you pay off the tax, the real money that you can keep with yourself, you can distribute among yourself, or you can reinvest in your firm or whatever. The real money that you can keep, the profit, is the one which you get after deducting the tax, and this we call it after tax nominal return. So till this point, everything is clear. So basically, there are two types of return. Let me just write it down. There are, say, two types of return. So not return, there are two types of earnings. Okay, there are two types of earning. First one is your income, and second one is your capital gains. So this is exactly what is taught or mentioned in your CFA book. So there are two types of earning. First one is your income. Second one is your capital gain. So basically, these two earnings, income and the capital gain, they are taxed differently. Okay? I'll repeat, these two types of earning, they are taxed differently. How we are going to see in a while. So basically, what is income and what is capital gain? We need to understand that as well. So let me just write it down. Let's understand income first. What exactly is an income? Let's understand this. So basically, let's say that you have some assets. Your asset number one could be, say, bonds. I'm not going to explain what bonds are. These are like debt instrument, or it could be, say, you hold an asset called shares or equity. You could also be having property. That is your real estate. Okay. So basically bonds, if you hold this asset, it gives you something called coupon at certain interval of time. Could be monthly, could be quarterly. So basically you get money. And if you hold shares, you get something called dividend. And if you hold a rental property, that is real estate or a building or a flat, you get rent. Okay. So basically these things, coupon, dividend or rent, they form a part of your income. Okay. These are basically considered as income. And in income, one more thing will be also be added. For example, if you work somewhere, if you work in a company, or if you are the CEO of a firm, basically, if you are an employee, CEO is also an employee of that firm, right? You get salary at the end of the month. So that salary will also become part of your income. Okay. And how these income are taxed? These are taxed. Usually what happens is these are taxed income. It taxed based on tax slab, which is again based on your earning. Okay. So usually what happens is like those people who are earning less income in a year, they are taxed less rate. Say for example, they might be taxed like 5%. And those who are earning a bit more, they might be taxed 8%. And those who are earning a lot, they might be say taxed 30% or say 20%. So basically there are slabs of earning slabs. So usually this is what happens in most of the country. So we are not going to talk about each one of them. I'm just giving you an idea. So based on your income ceiling or income which you earn in a year, you might be taxed accordingly. Okay. So that's why you must have heard that rich people are being taxed higher because their income is higher and all. So yeah, so this is basically what government does, and this is how income has been taxed. What about capital gain? Let's understand what capital gain is. I'll just rub it off. So you see that you have this assets with you, right? These assets. So to understand capital gain, I'll just write it. So suppose you purchase this bond, or could be share, could be anything. So suppose you purchase this bond at $100. Okay. And after a year, 1 year later, you sell it for $120 because the price of the bond rose. Okay. So you can see that you have gained how much? $20. So this is basically your profit. And this profit is considered as a capital gain. Capital gain. Okay. So basically when I say capital gain, it basically means profit that you earn from rise in the value of your asset that you hold. Okay, rise in the value of your asset. So if there is no rise, if you are losing, then you need not pay any tax on it. But if you have profited from the rise in the value of your asset, then you have to pay tax. But there is one important condition here. That condition is, supposing this bond which you purchased at $100, and after a year it is 120. What if you do not sell it off? If you do not sell it off, that means you have not realized the profit of $20. Okay, you have not realized, you are just holding it. In that case, if you have not realized the profit, then you need not pay any tax on it. Okay, once you sell it off, and in that instant, if you realize the profit, then only tax will be applied. Hope till this point everything is clear. So capital gain can also be divided into two types. One is short-term capital gain, short-term capital gain. Second one is, as you must have guessed, long-term capital gain. Okay, so these are also taxed differently. Basically, usually what happens is like, it's also mentioned, timeline is not mentioned in your book as well, but what usually happens is like, if you have bought and sell the asset in less than a year, it is considered as a short-term capital gain. And if you buy and sell the asset after holding it for more than a year, then it is kind of considered as a long-term capital gain. And how they are being taxed differently is, short-term capital gain, if you sell it within a year or less, in a very less time, you will be taxed at a higher rate. Vis-a-vis, if you hold it for a longer period, you might be taxed at a lower rate. This is what is usually seen in most of the countries. Okay, so this is how tax is been applied in different kinds of earning. So in income, it is applied differently, and the earning is also different, right? And then capital gain based on your short term and long term, it is applied differently. So coming back to the title of this topic, post tax and after tax, based on your earning, it is going to be different, and also it matters a lot. And I mentioned that keyword, right? Nominal. Nominal, basically, it means, let me just say, nominal, it actually means that this includes inflation effect. So inflation has been considered. So I'm not going to talk much about this right now, because in the next video I'm going to talk about real return and nominal return. So in that video, I'll properly explain this concept with the formula, which we have also talked in the first video, but I'll try to clarify it as much as possible. So thank you guys for watching, and see you in the next video.